Hi, my name is Denver Noas. This is a deeper dive in IUL expenses, indexed life insurance expenses, a very controversial topic. Hopefully I can shed some light on this. Now, whenever you're out looking at an IUL, there are plenty of tools that the advisors have that can analyze the costs and charges. They can actually do this for any investment that you're investing in, whether that's your simple 1% management fee on your investment account or as an IUL. So when we look at when we put all these into the system and analyze all this, what we'll see on an IUL, and this is again someone starting at age 46 and going through age 85, costs average about 1%. Not bad. But the question is, wait a second, I thought IULs were super expensive. And I think part of that is that the average cost is actually a little bit misleading. So let's look at that a little bit closer. So if we look at this after the first 10 years, so again, age 55 through 85, what we see is the average is actually 20 basis points, less than the cost of an index fund, which is actually pretty amazing because you're getting, tax-free distribution, you have the options, you have income, all those other things. But again, we're back to why are we always hearing that IULs are, super expensive? Well, let's look at those first 10 years of the policy. Here we go. What we see is the average of those first 10 years is 4.76%. And again, if you're going to sell against an IUL and sell into investments, now I'm an investment advisor. I do investments. I do insurance products. We use real estate. We use businesses. We use all kinds of things. I'm not captive to anyone's strategy. But if I was going to sell against it, you're going to sell against this right here, an average of 4.76. But let's look at that even a little more detail. Let's take a little bit deeper dive and see what actually is happening. So I want you to think about this like a 5-story apartment building. Let's say you own a building and you obviously what's the thing you want to do? Well, you want to get all these floors rented out as fast as possible because you're paying for the entire building. So this is exactly what happens with an IUL or an index life policy, except the IRS won't let you rent it out all at once. They limit how fast you can put the money in. So it actually takes 5 years for you to get all of the money in. But you're actually paying for this entire building from the beginning, which is why when you look at costs are much more expensive and continue to kind of get cheaper as you're able to get it funded. So when you're looking at the options, these typically earn anywhere from 6 to 7%. Let's use 6. What you're going to see then is the cash flow starts to get cash flow positive by year 3, gets more and more positive by year 4, and it continues then to drop off that cliff. And that's where, boom, then you get down the road, you're into this 20 basis points super inexpensive strategy. So the option strategies will cover the cost, but it does take that 4 to 5 years to break even. It's important, though, when you're doing an IUL that you're blending it with term insurance to reduce the cost as much as possible. And I always talk about people compare the entry cost with the tax savings you're going to have down the road, which we'll get into a little bit here in this video. But the cost will average long term. But again, let's go back to, is an IUL expensive compared to what? Well, let's look at a traditional equity account. So I'm an investment advisor. If you come in, we use Charles Schwab, and I charge a 1% fee. And the thing is, the industry, my industry, has sold people on the fact that, hey, you don't want front-loaded investments. You want everything to be cheap, 1%. Well, what they forget to tell you is this simple 1% management fee gets bigger over time because it's based on a percentage of the account value. So now as I get out to here, and then also if I'm investing in a taxable account, not only do I have management fees, but I have taxes coming out. Have you ever in any of your investment experience went to an advisor investing in the market in a taxable account and had them show you what the fees and what the taxes add up to? No. You go, how much does it cost? They go, oh, it's 1%. No, that's not actually what it's costing you. And so that's what these numbers will show. Once you start cumulatively adding up the fees and the taxes, you start getting a much different picture because the fees are growing the bigger the account value gets. So now if we go over here to age 65, in this traditional investment account, you see the fees now are $13,837 per year, taxes $20,000, it's a taxable account. So the annual cost of taxes and fees is $34,000. In the IUL, everything was front loaded, so now my total fees, I don't have any taxes, are $1,456 per year compared to my equity account, which is $34,000 in fees. Now, here's the big question. When you get down to a distribution phase, do you want your taxes and fees to be lowest or highest? Okay, right? It should be pretty obvious. Do you want your fees to be lowest or highest during retirement? At distribution, you want your fees and taxes to be the lowest. So what Wall Street has sold everybody is a strategy that is going to be the most expensive during distribution. This is called fee drag. Now you get down and you're trying to withdraw money, your costs and fees are the highest at the highest level that they've been at because it's a percentage of the account value. So you have more drag coming out. If you have a couple market losses, boom, that's why everything, people are going through their 401ks faster than they thought because no one showed them that everything is backloaded. So you go down here to year 30, what you see is still $20,000 in fees coming out, $30,000 in taxes, $50,000 versus $2,900 in total fees coming out of an IUL. It's so dramatically cheaper, it's not even on the same realm. So that's why, in my opinion, that it's almost better to not use average rate of return. And this is the same chart going all the way out to age 100. What you really want to look at is the cumulative equity cost or the cumulative account cost. So this blue line is the cost of a traditional equity account. Again, using 66% growth, adding dividends, you got a dividend tax rate, you got an income tax rate compared to the IUL. The green is the IUL, cost dramatically cheaper over time versus the equity cost. And then when you start looking at distribution, I'll give you another look at it. Here's the cumulative cost. So total on the IUL, $235,000 expenses and cost of insurance, all invested in a taxable account with a simple 1% management fee. The fees alone are triple, and then taxes on top of that add up to a much bigger number. So, and the distribution, in this particular case, favors the IUL, right? The green is a max funded IUL. It's going to provide a lot more value with distribution of income, tax-free income, and death benefit, where the equity account value is not going to provide near as much. Now, that's not to say that IULs are the perfect investment and that everyone else should have one, but knowing that when you really analyze it and you look at the numbers, IUL expenses are front-loaded, versus traditional accounts which are back-loaded. You really want to have your expenses low at retirement and have all those costs and fees out of the way. Cumulatively, the index life expenses over time are less expensive in fees and taxes than alternatives, such as an equity account. And the IULs, as a percentage of the account value, tend to be very cost efficient during distribution, like I showed in that first slide out of that 20 basis points. Now, that again doesn't mean that everyone should go out and have an IUL. I actually don't think these work well when you're funding $500 a month, $1,000 a month. Like some of these people in where they're selling them on TikTok. I think these need to be max funded. I think levels of 25 to 50 grand per year are more in line of where it needs to be. And even better, you use like the tax-free matching program where you get 75% of your premium funded, or 3-to-1 matching on contributions, some of the other strategies that we use. I think those are going to make it even more efficient. So I hope this answers a few questions. My name is Denver Noes with wealthforlife.net. Please reach out if you have any questions.